G'day expats, welcome to another episode of Expat Mortgages. As always, joined with my co-host, Jeremy Harper. Good morning, mate. How are you?
Very well, thanks, James. Happy Friday. Happy Friday to all our listeners. Hope everyone's having a great week.
Absolutely, mate. Friday, 27th of March, winding out a weekend. Gosh, there's been plenty going on around the world,
Yep.
whether you've been following along in the Middle East and a looming deadline, or whether it's what's going on back in Australia, a bit of stagflation starting to kick in and a few other things. But today I thought, what a good opportunity to do a bit of Q&A based on our clients and listeners sending in a couple of questions. We'll try and run through about 4 to 5 because there's some really good talking points there. So why don't we jump into it? This is a good one. I think this is just so topical right now because there's a bit of an unknown element, and I'll read out the question and then I think we can talk about it. So first question, first cab off the rank. What is your thoughts on the general consensus on the property market this year and next year, given a likely period of stagflation and interest rates going up once more? How should the investor be looking at this? What a good question.
Great question. So obviously when people talk about property investing, it's always long-term vision.
Yep.
So if we talk about what we think or what I think is going to happen in the next 12 months, obviously there's going to be a massive period of uncertainty. And I think I just look back in what happened in COVID and, prices flatlined and then they went backwards for that period of time. And then they just sort of whiplashed and off we went, right? Now that was in also a response to what the RBA did to interest rates during that period. They obviously
Yep.
dropped that. I'm not saying that's going to happen this year, but potentially, how this unfolds over the next 12 months, the RBA may cut before people have that estimated right now.
Yep.
But I think just it goes back to sort of the fundamentals, which is thinking about investment in property in the long term and then where you're investing. So this next 6 to 12 months is going to present some great opportunity. If you're looking to buy into a blue chip area, which you were priced out of previously, and now we can see the data's coming through that some of the auction clearance rates are soft. People are now selling properties before going to auction. They're even being pulling from the campaign. So that means that it is turning into a bit of a buyer's market. So I always think if you want to get yourself into that blue chip suburb 6 months ago versus today, nothing's actually really changed. Yes, some of the short-term data that's out around globally has changed, but long-term rates start to get cut or normalize and the confidence comes back in the market. Yeah, investing in those key areas is still going to give a great result in the long term.
Yeah, I think it's interesting. You look at like going back to COVID-19, which from COVID-19 to now, it still just seems like a blur, to be honest.
Yeah.
And then there's just been so much that's been happening. Very different. I think you framed it really well there. Very different to COVID-19 where the RBA dropped the cash rate. We had not much by way of inflation. Inflation was still in that target 2 to 3%. Unemployment rate went up. You had the cash rate at dirt cheap 0.1%. And then the property market slowed right down and pulled back only a small amount. I still remember it. It was sort of March through to maybe June, July, the property market sort of pulled back a little bit. But then when we came into August, it's like it just had a rocket placed underneath it and the demand went up because everyone was starting to realize, oh my gosh, interest rates are so cheap here. Or debt is so cheap that I can buy this asset class. And it really drove the property market into a quick period of growth. We look at the scenario right now, stagflation. Stagflation means high inflation, high unemployment rate, and then at the same time, interest rates go up. So it's this really unique situation that plays out, but it is different compared to COVID-19. I think if you're an investor that's looking to crack into the property market, much like COVID-19 or much like when interest rates went up in 2022, I believe, when interest rates started going up again, the property market slowed down, sidestepped. There wasn't massive drops or anything like that. We haven't really had a massive correction on the property market for more than probably 50 years, to be honest. But those that could afford to invest through that period of higher than average interest rates, they were really fortunate because the market and the demand in the property market had come down. We're seeing greater vendor discounts. So those that were selling properties were willing to take a bit of a bath or a bit of a discount.
Yep.
And then when interest rates went back down, the property market lifted, and you had some capital cities, Perth is a great example, doing double-digit returns, Adelaide doing double-digit returns, Brisbane doing sort of 8 to 11%. I think Brisbane also had a 12% there. So those that can afford to get in and crack the market, probably the next 12 to 18 months, I think they're going to enjoy, obviously after that period, a really, really strong period of growth. Whereas those that can't afford to get in and are priced out of the market, maybe due to serviceability, they'll probably struggle a bit when they try and crack into the market when interest rates start to come down, because that's when the heat will really come back into the market. But
Yeah.
I think when I've spoken to some buyers agents this week and last week, especially northern New South Wales, Gold Coast, and then even up to the Sunshine Coast as well, they have said that they are starting to see a theme where the theme is starting to switch more into a buyer's market, because vendors are willing to take a bit of a discount. Those that are selling their property, they're willing to take a bit of a discount. And if there hasn't been much interest in it leading up to an auction, they've been pulling it from auction and then selling it pre-auction as an
Yep.
example, because the seller isn't willing to take the chance. So it's a theme we're seeing. So all in all, if you're an investor and you've got still good serviceability, you're priced well to still invest in property, this is the time when you want to absolutely crack into the market. There's a really good Warren Buffett saying where he said, you need to be greedy when others are fearful and be
Yep.
fearful when others are greedy. When it comes to the property market, that's what we're sort of switching into right now. People are starting to get a bit more fearful, and therefore that's where you should be greedy if you're priced well. Conversely, look at the share market. Everyone's starting to get a bit fearful. Market's dropped as well. So those that are looking to invest in the market, well, if you're dollar cost averaging right now, what a great opportunity. Things
Yep.
are sort of, I suppose, at a discount, and we're sort of taking a step back to where we were probably around May, June last year on the share market. So definitely buying at a discount. But that is my 2 cents on the matter. I think we've covered that. That's a really good question. Yep. Yep. Next question. This one is a good one for you, Jeremy, because I cannot answer this one. Can I refinance and access some cash and put it in my offset account for a rainy day as an expat? For example, I want to cash out, or I want 100K to cash, sorry, in the future to access.
Yes. So short answer is yes. That's something that people have been having that conversation with quite a bit. Depends on where you are based.
Hmm.
If it's the Middle East, you maybe want to just have a bit more cash there
Yep.
for potentially using for investment in the future, or just to sort of something to help you sleep at night. That's
Hmm.
something you can definitely do. A lot of banks will still offer an offset account, can have interest only. So if that's something you're interested in doing, in this example, you pull out 100,000, you put it in the offset account. We've set up an interest only loan. So if as long as the cash is in that offset account, you don't actually make any repayments on that loan. So, it's good for your cash flow as well. It can just sit there if you want to use that into the future. So yes, you can.
Mm. That's good. Yeah, definitely not locked out of accessing equity. Absolutely. Next question here, and this is about trust lending. So for anyone that's listening today, and this is the first episode, go back a couple of episodes because we unpacked a lot of the changes around trust lending early in the year,
Mm.
um, mainly brought on by your finfluencers and your online influencers, um, and a lot of banks just sort of saying no more. But the question here is trust lending now pretty much impossible? What about if you're putting in a good, healthy 30% deposit?
So a couple of ways to answer that. Obviously, if you're onshore, trust lending is still available. There's still quite a number of lenders.
Hmm.
You could probably go up to more of an 80% LVR, even into a bit of LMI with some lenders, so 20% deposit. If you're offshore and you're wanting to buy, or you've got existing property in a trust, you want to refinance and get equity out, that's still available. Definitely. Again, maybe 20, 30% deposit. Again, depends on the bank, and how much equity you got in there. So yes, there's options there.
Yep. Okay, that's really good. Yeah, because feedback has been a little bit negative around trust lending after some of those big banks came out and said
Yeah.
no more, no more.
Yes.
Um, Another question here, topical, related to everything that's going on in the Middle East. Uh, I'm a non-resident and I've come back temporarily to Australia due to everything that's going on in the Middle East. Can I still get a loan if my income is still consistent? I'm still employed via the Middle East country, but I'm just company. Sorry, I'm just currently in Oz temporarily, so I'm still a non-resident essentially.
So non-tax resident, let's assume they're Australian resident.
Yep.
So very similar to what we were saying before. It's like COVID again, right? A bunch
Yep.
of expats from abroad came home during COVID. So yes, that's a possibility. You know, what the bank wants to understand is we can still perform our job remotely whilst we're in Australia, and obviously we're still receiving that income, and there's no changes there. So you may just need to get something from HR to confirm that along with your pay slips,
Mm.
and then we can proceed under that sort of structure. Yep. So that's
Yep.
definitely something you can do.
Yep. No, that's good. So it sounds like regardless of what's going on like around the world right now, like obviously banks are still lending, interest rates have
Yep.
gone up a bit, fixed rates have changed, but I guess it's the same themes. People are still investing in property. They're still getting loans. Those that can are probably quite fortunate because we know what the property market will do after this period of interest rates being a little bit higher
hmm
and then coming back down. Um, are you monitoring? And I think we've talked about the forthcoming budget a lot, and how Labor could have a bit of a wish list in terms of changing and tweaking the capital gains tax discounts, concessions. I'm wondering whether we'll see any changes around income tax rates at all, and whether they'll talk anything about like the theme that they're seeing, this SaaS apocalypse, AI, and them needing to maybe increase company tax rates because they're not going to be getting as much revenue potentially from individual or marginal tax rates. I don't know if you've thought about that at all. You got any
Well,
feedback on that
I
one?
I saw that they're sort of talking about supporting some sort of offshore gas tax
Yep.
because the pressure that's been, I mean, I think David Pocock's been really,
He
has
has
actually been
been.
really good with pushing that. It's been
Yep.
getting very effective in getting people thinking about it. What's interesting is, you know, the budget's they probably had their wish list set out late last year after they got back in after the election
Mm-hmm.
and thought this is our goal. But obviously the last 6 months, the economy, interest rates increase, inflation's higher. What you've got going on in the Middle East has all changed. So I think that will be interesting. Will they have the nous to sort of maybe pull back some of what those agenda items they initially had? Because perhaps is that going to be a bit too much to put into this economy at the moment? I think you'd hope so. You'd hope they'd sort of shade back exactly what they're trying to put through. Maybe go some of these items will push through or put on the agenda next budget.
Yeah, absolutely. Good point there. Um, Another question that we've had come in, uh, for our listeners, you might have been keeping an eye on some of the news that's come out about like a lot of fraud happening in a lot of the big banks and the lenders and like bank statements and pay slips, everything being, I guess, created and like just completely gobbledygook and aren't real or anything like that. I don't know. Have you seen anything on your side, Jeremy, about any changes potentially coming afoot for how you assess a client or anything like that because of the fraud, or not really too early in the piece?
You're seeing more and more just on the employment verification because I think that's the key component. You know,
Yep.
a lot of that fraud comes through dummied up pay slips.
Yep.
So a lot of banks now, which actually kind of makes sense, where they're just saying because of the up-to-date reporting to the ATO every pay run, they will just say, can you just go into your MyGov and print out year-to-date income summary from your
Oh,
employer?
wow. Okay. Yep.
Which sort of makes sense because that gets
Does.
updated instantly after you get paid. So
Hey. Yep.
it's sort of taking away the need to see pay slips and just saying we're going to verify it because that's coming from the ATO. The funny thing
Yep.
around that is the ATO software, for whatever reason, for a lot of people that produces that report, doesn't have their name on it. So the
Oh,
banks
gosh.
which is, I think it's just an error from the software point of view. It's legitimate.
Yep.
So I think that's the big change that we're seeing
Yep.
more and more around that sort of verification. For
Yep.
expats, there's always been multiple levels of verification.
Yeah.
You know, quite often they'll get pay slips, work contract, bank statements, and they'll obviously Google the company. A lot of credit teams will go onto LinkedIn and understand like where that person's been. And so they're using a lot of additional data to kind of piece together that loan application. So it is surprising that, you know, I think it'd be harder to put through fraud if it's like a PLYG, someone working in a larger company, but when it's a smaller business, maybe it's self-employed, maybe it's a friend's business, they're the ones that probably attract a higher risk, which is not really an expat type deal.
No, no, not at all. I mean, it was just when that all came out. I mean, I guess this was going to happen at some point. People using
Yeah.
AI to generate and create fake pay slips and fake bank statements and other things. So, it makes sense to tighten up. Sorry, the income verification. Absolutely. Good question there from one of our listeners. That's all we've got for you, ladies and gentlemen. A bit of Q&A today to obviously get a bit of a read on the market and what's happening, and obviously what's happening in trust lending, and even those Aussies that have bounced back to Australia temporarily while the Middle East conflict continues on. Jeremy, as always, thanks for your time.
Thanks, James. Thanks, guys.